Hello, you're watching Smart Money, and Philip Bradford, who's Chief Investment Officer at PortfolioMetrix, joins us today with his views on the South African fixed income market. Philip, good to have you with us. But before we get to any of that content, you've held various asset management roles and have managed quite a few funds. What would you say right at the top are the biggest challenges that come with managing a fund right now?
Well, it's a huge responsibility. You're managing people's money, you're managing their nest egg effectively, and everyone spends their whole careers trying to make money, and almost nobody spends any time actually looking after it or learning how to manage it. So, luckily, it's my passion. I love it. I enjoy it. I love talking to investors about it as well and helping them. So, the biggest challenge when you go from millions to billions, people start getting stressed, but it's really about controlling your emotions as well, and learning to take advantage of what's going on in the markets rather than getting caught up in the noise around it. So the hardest part is probably controlling your emotions, and it's something I've been working on for many years.
Yeah. And like you say, the challenges are always going to be there, no matter what kind of fund you're managing. But despite that, PortfolioMetrix recently won Best DFM at the Professional Advisor Awards 2025. Added to that, you've won 3 other awards for the PortfolioMetrix BCI Dynamic Income Fund as well. So is that what you attribute the kind of success you've been able to reap down to?
I think, the temptation when you're managing investments is to sort of, try too hard to win and not focus on the risk management too much. So, our awards in the UK for the best discretionary fund manager, and then a lot of the fund management awards in South Africa are kind of a result of many years of trying to be consistent and more conservative, actually. So it's a case of actually managing the risk. And I think the way we manage it is very much with the managed portfolios, very much with the end investor in mind. We want a smoother ride. We want investors to stay on board as well. That's such an important part of it, because we know from all the behavioral studies and what goes on is that investors are typically their own worst enemies. And I include myself in that. When your own money is involved, emotions are involved. So it's really a case of building a process and making sure that we manage investments in a way that investors are going to stay along for the ride.
Yeah. And consistency, managing to achieve consistency, quite a feat in volatile times, right? But some of that track record laid out there, let's get into your thinking then, and to what ultimately affects positioning in the market. I mean, South Africa's rising debt burden, for one, has been squarely in the spotlight. So has it changed your view on South African government bond exposure? And the key question right now, seemingly, is it time to switch out of South African bonds?
Well, it's a great question, and the thing is, this is not something new. A lot of let's say equity investors, other investors focus a lot less on these kinds of things. As a bond investor, and I get involved in all different asset classes as well as the CIO. So, but bonds are kind of your base load or your anchor in your portfolio at the end of the day. And the bonds are influenced by everything that goes on around the world. So something like the debt to GDP in South Africa basically means that South Africa over the last 10 years has increased its borrowing significantly. And its interest burden gets higher and higher. But at the same time, though, is the available rates that we can get out of bonds are much higher because of that. So, if I go back to 2008, 2009, cash was 12% I could get 13-14% out of money market instruments, and bond deals were only 8%. Now it's the other way around. Cash is like 7%, and we're getting 11.5%, nearly 12% out of bonds. So it's not just a case of looking at the risks and things that are playing out. It's actually looking at what is priced into the market. So while we are not happy that the GDP has gone up as much as it has, as a bond investor, if you're going to buy a 20-year fixed deposits or a 20-year bond, you've got to take a 20-year view. You can't look at what's been happening in the past. And what we're watching very, very closely is what is the trajectory for South Africa. And as much as there's a number of negative factors at play, there's also a number of positive factors at play. So South Africa we got downgraded to junk a number of years ago now. Following the Nenegate blowout at the end of 2015, we eventually got downgraded to junk a couple of years later. And actually, if anything, the market is starting to factor in South Africa making improvements over the next few years and starting to move back potentially to investment grade status. So while we can talk about AGOA and we can talk about Trump and other things, actually the tide, ironically, is starting to shift a bit back in South Africa's favor post the GNU government and some of the reforms that the Treasury have been making over the last few years. It's not great yet, but as an investor, you tend to make your most money when things go from very bad to bad. If things were great in South Africa, our bond yields would be 4%. They would not 11.5%.
Yeah, absolutely. And, I guess it's important to highlight as well that the perception is anything associated with government means risk. But let's stack it up, for those out there listening to this conversation right now, when it comes to risks versus opportunity, especially looking at some of the economic metrics, Philip. I mean, inflation, growth, and impact on interest rates. That's one thing. But also being fully cognizant of, the politics in play as well, both locally and globally. So what are some of the considerations that are being weighed up against each other?
So it's really important to understand everything that influences our bonds. And actually, local domestic politics and the likes is actually quite small. The biggest driver of our interest rates in South Africa is where the interest rates are everywhere else in the world. You need to keep your interest rates in some kind of equilibrium with what's going on in the US and the rest of the world. If they can cut rates further, we can cut rates further and vice versa. So our rates reach some kind of an equilibrium so that to keep our currency stable. And that's what the Reserve Bank does. So what we're looking for at the moment is to try and make sure that the rates are high enough to compensate us for a lot of the risks. And actually, that's what we sort of seen playing out, is that despite a lot of the political noise going on, you actually haven't seen South African bonds react as much as you've seen other emerging markets. And what you've got at the moment is inflation is actually relatively benign in South Africa compared to many other countries. 3.2% at the moment. And long-dated bonds, we look at our dynamic income fund, we yielding over inflation plus 8. So the one thing that South Africa's got in its favor is that inflation is relatively low, which means our real interest rates are over inflation plus 8. And that's very attractive to foreign investors. And when you compare that to the likes of Brazil or even Mexico, which has its own problems with Trump and the likes, is actually South Africa is kind of, inflation's quite low and relatively benign, and our interest rates are very high. So the foreigners are actually, many of them are quite happy to buy our bonds. They might actually just hedge out the currency risk where most of the risk actually plays out.
Philip, you touch on international investor appetite for South African bonds, right? But I've got to ask you, is it a case of South Africa just presenting itself, I guess, as the least ugly of the ugly sisters right now?
Well, it's a great point. We like to say that South African bonds are the cleanest dirty shirt in emerging markets, I think. And, the likes of Brazil, Mexico have much bigger problems right now than we do. Turkey, even more so. And the foreign investor community are very used to looking at South Africa through an international lens. You're comparing where you can get 4% on US treasuries, less in the UK, and you can get 11 in South Africa. And with our inflation relatively benign, it actually makes us look quite good. And they're very much forward-looking as well. So, there's this perception that foreigners don't own South African bonds anymore. If you look at what they own, over R1 trillion worth of South African government bonds on the JSE. As a percentage, they used to own a lot more, but they still own a lot. So they are very much aware of the challenges we have in South Africa. But South Africa, in some respects, is better off than most of the other emerging markets. And most importantly, on an improving trajectory. It's not great yet, but that's also the opportunity. That's why we're getting over 11% yields currently. So it really is important to understand that the yields on South African bonds and what's available is hugely impacted, not just by what's happening in the US and everything else in South Africa, but also what's available everywhere else around the world. We are competing for investors' money with all the other countries around the world. And if our real rates, in other words, our yields minus inflation, are attractive, foreigners are quite happy with that. So we've seen that foreign investors haven't flown back into South Africa just yet. I think once we start moving back towards investment grade, hopefully over the next year or so, we could quite easily see foreign investors come back very quickly in advance of that. And we started to see a bit of it, particularly after the governments of national unity came into place.
Yeah. So what's your advice then, Philip, to someone wanting to buy long-dated South African government bonds as a buy and hold strategy?
Yeah, the buy and hold is a tricky one because that changes. Some of the government bonds are yielding 8%, some of them yielding 11.5%. And some of them have got 2 years to go, some of them have got 30 years to go. So it's really a case of which ones are you going to hold. And that's why we hold a diversified portfolio of not just government bonds, but we hold the bank bonds of Standard Bank, First Rand, etc. And a combination of that allows us to change over time. Bonds, if you go back to 2012, some of the bonds were yielding 6.5%. Those same government bonds now are yielding 11.5%. So the world changes and you need to be able to change with that. And to lock yourself into a fixed deposit yield, which is largely what a bond is, for 20 years, you better be sure of your view on those bonds over that time. So really you need to be dynamic and you need to adapt to that. And when interest rates start coming down again, then you want to get out of those same bonds and move into other ones. So there's lots of different types of bonds: floating rate bonds, fixed rate bonds, corporate bonds, government bonds. So just to lock yourself into one bond issued by the government is probably not the best idea.
And accessibility to that, that accommodates that kind of flow has become or is becoming easier, right? We've got a platform like Easy Equities, for example, having recently made South African government bonds accessible to retail investors. But talk us through other ways retail investors can get exposure to government or corporate bonds for that matter.
Well, yes, and government bonds, there are sort of 12 or 15 of them, but there's over 2,000 bonds on the JSE. So you want to be able to access other types of bonds. You want to access the bonds, as I mentioned, from the banks or the insurance companies or other sort of corporates. The problem is those are not very liquid or not very accessible. They typically are big institutional markets. When we buy a bank bond, we go and buy 50 million at a time, or government bonds, we'll buy a couple of 100 million at a time. It's not so easy to just go and buy in smaller amounts. So it's great that an Easy Equities has made that available, but they've also made available our ETF, which the PMX Inc., PMX INC ETF actually allows investors to get involved in a portfolio of bonds like we're holding. So we're holding 10 or 20 different bonds or 30 bonds that an investor can get access to all different types, rather than just saying, oh, I'm going to lend my money to the government and buy one bond. And that's a far more prudent approach over time, because then we can make those changes when the environment changes. And the environment changes a lot. Interest rates have moved dramatically. I've been in the markets over 25 years. Cash used to be 12, 13%, and bond yields used to be 8. Now cash is 7 odd, and bonds are over 11. So you can't just lock yourself away for 20 years and assume the world's not going to change.
Absolutely. Well, Philip, let's leave it there. Thanks so much for having joined us on Smart Money today. Philip Bradford is, of course, Chief Investment Officer at PortfolioMetrix.